Hi friends! Today we're going to talk about a story that sounds like a legend. $24 bought Manhattan Island. Yes, you heard that right. The island of Manhattan, full of skyscrapers, wealth, and dreams. But don't jump to conclusions. It's not a simple story. In 1626, what about Peter Minuit, the Dutch colonizer? The equivalent of $24 in today's dollars for the island of Manhattan. Yes, it is this place where the annual GDP is now over 400 billion US dollars. Is this the best deal ever? At first glance, this deal seems to have been taken advantage of by the Dutch. But if you think it's a safe bet, that would be a big mistake. Let's use some easy-to-understand data to analyze the reality of this deal. The first is the return on investment. Peter Minuit's return on investment is only 7.02%. That's 70 cents a year. What about the average return on US stocks over the same period? That's 10.23%. That's about $1 a year. The average return on long-term US Treasury bonds is 5.1%. That's 50 cents a year. That is to say, if Peter Minuit had invested the $24 in the stock market, you can earn an extra 30 cents a year. The second is the change in land value. In 1626, the island of Manhattan is worth $24. 2,000 years ago, the island of Manhattan was worth $2.5 trillion. The value of Manhattan has grown 100 trillion-fold. The third is the potential benefits for Indians. If the Indians invested $24 in the stock market, by 2,000 years, the investment would be worth $7.26 trillion. They could have been the richest people in the world. But what? It's not like that. Indonesians couldn't have predicted that Manhattan would develop into the superus land it is today. They also cannot afford the risk of investing in stocks. So, what about this deal for them? It's not perfect. Let's analyze another case. Suppose there was an investor in the early 20th century, invested in a wasteland in California. At that time, this land is almost untouched. The value is extremely low. However, with the rise of Silicon Valley, the value of this land skyrocketed. It could be worth thousands of times more. This case also shows that changes in land values largely depend on external economic and social development, rather than the intrinsic value of the land itself. The famous investor Buffett once said, "If you don't know how to invest, don't invest in land." He found it difficult to value the land, and poor liquidity, the investment risk is relatively high. Of course, some experts also believe that land is one of the best investments for long-term value preservation and appreciation. They have a point of view. Investors should make judgments based on their risk tolerance. So what does this story tell us? Investment. There is no sure profit and no loss. No matter what you invest in, there are certain risks involved. The value of land will change over time. Some land can become very valuable, and what about some land? It will become worthless. Investing is about doing what you can. Don't put all your eggs in one basket. We need to diversify our investments to reduce the risk. Okay, I know. What about this story? It may have upended your perception, but that's what investing is, full of unknowns and risks. Only through continuous learning can we make smarter investment decisions. I hope my video can give you some inspiration. If you like my vision, frequency, remember to like and follow.